Thanks. Thank you, Paul, and good evening. I was just approached by Patrick Michaels, and he said, Martin, and he's a bit nervous, you know Patrick. He says, Martin, our dinner guests are getting restless. How long are you going to speak? And I said, don't worry, Patrick, don't worry. I'll have everybody out of here by midnight. Okay, so that's how we'll go. Okay, now I had a talk at the Zurich Gold Show on Tuesday morning, where I had a very long-winded and very complicated, economically intricate sort of presentation that I think most people kind of fell asleep on. It lasted about an hour, and it took me that long to say that gold prices are going to probably be a little flat this year. Okay? So I thought, you know, in lieu of that, we would do what I did 2 years ago and bring up some interesting dinner conversation type topics. Right? What the hell is going on with the world? Why are we still here? Why hasn't the Eurozone fallen apart? All these pleasant sort of things that we would like to talk about after we've had a glass of wine. And just to be sure that I still have mine right here, I want you to know that. So I'm going to start, but before I get into the meat of the matter, I just want to tell you, some of you will not know what economists do. And so I came across this particular sequence of slides that gives you a better sense of what economists actually do. Okay, this is from Dilbert. And Dilbert there is presenting, and he says, I didn't have any accurate numbers, so I just made up this one. And it's 4,629,873. That's the number he put on the slide. Because, he says, and economists would understand this, studies have shown that accurate numbers aren't any more useful than the ones you make up. Okay, well, that's interesting. And you know, if you follow Dilbert, you know that he has this pointy-haired boss. And so the boss asks him, how many studies showed that? And he says, 87. Okay, so that's just, because you think, well, economists are like accountants. No, we make up numbers when we assume numbers if we can't really figure them out. So that's what I'm going to throw at you. Okay, I want to say a couple of things about global debt crisis. Those of you that have an interest in gold, which I presume are many of you, will see that there is, through these pieces, little bits that are of importance to the gold price. The house prices maybe not as much. But that's a special request. I don't know if Patrick is thinking of buying another house or if he is buying a house, but he wanted me to say something about the Swiss housing market. You know how dangerous that is, coming from Canada and telling you about your housing market? Okay, but anyways, so it's in there, and then we'll obviously have a couple of things to say about gold. Okay, I'm very concerned about the global debt crisis, and it's one of my key, if I could say it this way, key bullish gold factors for the medium long term as to why I think gold prices will inevitably drift higher. So let's get into that. Okay, here I have a chart, and you can see that it covers 4 countries, Japan, Western Europe, or 4 regions, Japan, Western Europe, Canada, and the US, 2010, 2015, and so forth. Okay, now what I'm trying to show here is super-aged. Now that's a definition that we're all going to get very used to. Okay? How we come to super-aged is we look at the ratio of people over 65 to those between 15 and 65. Okay, and if that ratio goes over 30%, you're officially super-aged. Okay, now there are 2 countries, Germany is buried here in Western Europe, but there are 2 countries at the moment that are super-aged, Japan and Germany. And you can see how this progresses as the baby boomer demographic bulge moves forward, that by 2030 and beyond, we're going to have an awful lot of super-aged economies. I say, okay, well, what does that mean? Well, it means something with respect to entitlements. Okay, now you all know that governments hand out what we loosely call entitlements. Now, the US actually has a definition of entitlements. I found it an interesting definition. The definition is, it is the payment by the government to an individual for which no service needs to be returned. Okay, so it's a one-way payment. Okay. Now, what I've got here is the breakdown of how the US budget is allocated. And you can see there, entitlements are over 60% of the US budget. Now, that may surprise you, because we always talk about the US being the capitalist economy and so forth. And in fact, a couple of years ago, I showed this chart to a reporter from Barron's. I was doing the rounds in New York, and she said, "Martin, that's a very interesting chart, but I think you've made a mistake." I said, "Oh?" She said, "Well, you're from Canada, right?" I said, "Yeah." She said, "I think you got the Canadian chart, right? Or you probably have a European chart, because God knows they're all socialists over there, right?" We had to send her all the data, and you can Google it, it's in the records of Barron's. We had to send her all the data of all the payments the US government makes on entitlements. Now, just for some of you that are my age, and I'm, more advanced, note that back in 1970, the big item in the US budget was defense. Now, this is as a percent of the budget. It's not a dollar amount, it's as a percent of the amount spent. Now, I am an old right-wing Attila the Hun type. Okay, and I think that's what government should do primarily. Defense is your number one responsibility. Defense and a judicial system. Okay? Most of us here have some knowledge of financial management and clients and how we look after them. It's our job to look after that entitlement part. You invest, let's say, with my company, and we hope to provide you with a comfortable retirement, right? That's the nature of the beast. Of course, governments have gotten into this. So now you put these two things together, right? More entitlements and older populations, and you get this sort of attitude. Now, this is another one of my little jokes, and this is an actual picture that was taken at the Take Back Wall Street event a few years ago. This woman is holding up a placard, and I'll read it for you. She says, "I spent $96,000 for a BA in Hispanic, transgender, gay and lesbian studies, and I can't find work." Now, I don't want to, insult this lady, but the question is more fundamental. Is it the government's responsibility to make sure that she can find work on the basis of the choices that she makes? Okay, and that's a very fundamental question that we have to deal with. And that's what comes with entitlements. Okay, so what this works out to over time, as we get older, and the entitlement system keeps running, government debt levels are very likely, they don't have to, but they're extremely likely to continue rising. So there again, I have some of the culprits: Japan, Greece, Italy, Portugal, the US, and so forth. In fact, these are the 7 or 8 most indebted government countries of the developed world. All right? Now, I've got a line there at 90%. Now, I don't know if you've read this book. It's quite a serious book by Reinhardt and Rogoff that says, "This time it's different." That's the title of the book, "This Time is Different." And in this book, they point out, through historical studies, that when your debt to GDP level gets over 90%, your economy starts to slow and all kinds of other things start to happen, right, that basically have the pressure of reducing growth in the economy. And that's a problem because, of course, what you want to reduce debt to GDP ratios is you want a faster rising economy, not a slower rising economy. That's at the root of what the Greeks are complaining about. They want a faster rising economy. So to put it in a different format, this is how these things break down. A government can spend its money in different ways, on entitlements, on defense, on infrastructure. Other is the running of the government. That's not an insignificant amount of money. And then, of course, there's interest payments. So it doesn't take a genius, and there's not very much that's very complicated here. It doesn't take a genius to understand that if you have less entitlement payments, you can have more infrastructure, for example, right? More entitlements, well, you got to cut somewhere. Okay, now there are three big components that governments spend money on: entitlements, defense, and infrastructure. Now, all of you who have recently flown to LaGuardia will know exactly where the US is not spending money. Okay? I mean, this is, I don't want to say third world. I don't want to embarrass the third world. Okay? Okay, so, but now you have Europe, right? You have phenomenal infrastructure, right? You have great entitlements. And I'm Dutch by birth, so I think I can say this. When some defense people needed to be sent to the Middle East and Afghanistan and so, I think the Dutch were able to come up with 3 soldiers. Right? Because that's where that gets cut. Okay? So that's how these things all start to hang together. You make your choices, but you know, the world changes. You might need more defense in Europe. The US, God knows, needs a hell of a lot more infrastructure. Right? If I had a long time here, I would show you a picture of a diver in the New York subway system, because the whole New York subway system was underwater after the last hurricane. Okay? That's just infrastructure breakdown. Okay, so what do we do about all of this? We got these big debts and so forth. Well, the economics is simple. This chart is complicated, but the economics is simple. Let's look at Japan, just to give you a sense of how this hangs together. Japan there has a primary balance of minus 5% of GDP. Now, what is the primary balance? It's the budget balance before interest expense. Then nominal growth in Japan is estimated to be at 2.2%, and Japan pays 1.4% interest rate. Now, the arithmetic, as I said, is simple. If you add A plus B, and it is greater than C, your debt to GDP ratio declines. Think of it this way. If Greece is growing at 10% per year and pays 2% interest, we don't have to worry about Greece's debt to GDP going down. Okay? But if Greece grows at 0% and pays 10%, Greece has a huge problem, and obviously so do the creditors of Greece. Okay, now what I've got here is this 10-year bond yield to give you a sense of, you know, what the average interest rate has been. Now, these are not the actual interest rates these countries are paying, of course. That's just an indication. And particularly, and this is how you must understand at least part of what Draghi is doing, you know, with QE, is lowering interest rates. Because it's critically important that when you have zero growth, right, that you have as low interest rates as possible in order to try to come out from under this debt to GDP colossus that you're pushing around. Okay, but we have another problem. This is a picture of US real growth by decade. All right, so in 40 to 49, the US real growth rate averaged 6%. And you can see how it's gone. We are in a secular decline in real growth rates. And there's all kinds of debates. Ben Bernanke is out on the internet for Brookings, and Larry Summers talking about secular stagnation and so forth. Okay, we don't have to go into that. This is the straight data. I didn't make this one up. Okay, some of it I'll make up, and I'll try not to tell you. But this one I didn't make up. All right, it's just we're seeing a slower real growth. Okay, so now the question is, how do you get more growth if real growth is slowing down and you want more growth? Well, the answer is obvious. You want more inflationary growth. You know, the numbers I just showed you, that doesn't matter whether the growth rate is 10% real or nominal. You could have 0% real and 10% inflation growth. It adds up to the same thing. That's the growth rate, right? Now, it's unlikely that you're going to pay a very low interest rate if you have 10% inflationary growth, but the ECB could potentially provide that for you. So here's what happens, and this is part of my gold story, as it turns out. These are the government choices. It's not rocket science. Governments can reflate. They need more nominal growth. They have high debts. What do? Well, I say there, print money. Okay? What you're really trying to do is go for inflationary growth. And then I take right out of this book, This Time is Different, Inflate, Devalue, Default, Financial Repression. These are common things that governments have done in history. You default, you inflate, you devalue, and you have financial repression. Now, I don't know if you understand financial repression. Those of you that are Canadian will know that years ago, in our RRSP accounts, these are our tax-free retirement accounts, we could invest up to 20% of that account in the foreign sector. 80% had to be invested in Canada. Now, that's a mild form of financial repression. The law was changed, and now we can do 100%. But it's not uncommon for countries to say, listen, everybody, we have a problem. We need more money, right? You must now all invest in government bonds, our government bonds. That's financial repression. The other way is the austerity way. History has shown that the austerity way is extremely painful and very, very difficult politically. And you don't actually have to read the history books on this. You just kind of follow the headlines in the international financial press about how things are going in the Eurozone. All right? It is very difficult to have internal devaluation. Okay, this is a hawk, Richard Fisher, one of the Fed members. He's now no longer a Fed member. But he said this in 2011. Throughout history, feckless governments have dodged the fiscal responsibility by turning to their monetary authority to devalue the currency, monetize debt, and inflate their way out of structural deficits. Now, most of you, may think that the Fed is, some loosey-goosey outfit. So I just want to point out to you that this was one of the members of the Fed. They're not all crazy. Right? Now, the next sentence in this speech that he gave in 2011 was, and it is our job at the Federal Reserve to make sure that it doesn't happen in the United States, which, of course, is exactly what did happen. Look at the Fed blue line, right? Because the reality is, when you're faced with slow growth, high unemployment, and disinflation, there isn't a central bank in the world that will not want to print. Okay? That's just it. Okay? In fact, that desire to print was actually germane to the whole idea of pegging the Swiss franc to 120. And in my opinion, that peg was only released when somebody in the Swiss government realized that if Draghi is going to do QE at 60 billion a month, you guys were going to be washed away with money. And so something had to be done. But it is the natural instinct of central bankers to do this. And I put the red line in there, gold, because in the theories that I use and the models that I use, you actually do have an improvement in the price of gold when this happens. And note here, I've got the green line, which is the ECB, and we have projected it forward at 60 billion a month through September of next year. Okay, so that's something to think about. That's my point one of this pleasant conversation, and anybody that would like to leave at this point, because it gets worse. China. China in ascendancy. Okay, some of the key things that I think we should know and understand about China. And in fact, we can understand it about a general economic development. The higher the percent population in urban areas, the higher GDP per capita. Okay? So that happened in the United States, it happened in Canada, it's happened all over the world, and this is now also happening in China. You're getting now just over 50% of the Chinese population in urban areas. It's no surprise that the GDP per capita is in the order of $7,000 per month. Now, you look at some of the other countries, the blue bar there is the US. Obviously, that isn't rising very sharply because the US urbanized many years ago, and so you just get very modest little rises. The gray line is India. India is behind, but that's coming. But the China one, when you do the projections, and these projections come from the United Nations, when you do the projections, what I want to point out there, between 2010 and 2040, the simple projections are for over 300 million people moving from rural to urban in China. Now, let's take that at face value. They made those numbers up. I didn't make these numbers up, right? That's about 10 million a year. Okay, I I've forgotten what the population of Switzerland is offhand. Hey, okay, 10 million a year. You get a sense of how big this is. This is one megapolis. It's the jet lag here. Anyways, it's one large, very large city that is being generated every year in China. Okay? So that's huge. Second thing that's happening in China, they would like the RMB to become more of a world currency. Now, that has some import for us, and it has some import with respect to how the gold prices might go. China definitely wants the RMB to be used more actively in international transactions. There is this saying about exorbitant privilege that the US has. Now, I'm not a huge believer in that, but it certainly has been true historically. When you have a reserve currency, you can buy things abroad and pay in your own printed currency. That is a privilege that some people have called the exorbitant privilege. And China, I think, would enjoy that sort of privilege as well. But, you have to go through a few steps to go from, just basically joining the World Trade Organization in 2000 to having a world currency. And these are some of the steps. You have to have RMB convertibility, which China does not at this point. Limited. There's an offshore and onshore yuan and so forth. Deep capital markets. Why is that important? I can pay, I don't know if the taxi driver here would like it, but I could get away with paying in US dollars. All right? Because there is a market for US dollars, and the banks up and down Bahnhofstrasse will gladly take the dollars on deposit. Right? That's not so easy with the RMB. Okay? Because you got to lay it off back in the home capital market. So you need deep capital markets. And the other thing that we have seen in history is that to make a currency, a world currency, when it comes from nowhere, and believe me, the RMB has come from nowhere, right? I think the China has had like 3 currencies since the Second World War. I mean, it's relatively recent that China has presented itself on stage. Okay, so you need a gold guarantee. That's usually what happens. That's what Britain did, and that's what the US did. Hold our dollars. We will guarantee them in gold. If you don't like them, send them back to us. We'll give you the gold in exchange. Okay, and that lies behind the theories that China would like to add more gold. And that's what I've got here. In this table, you see China in December 2014. That's the latest IMF data. It says there that China's gold reserves are 1,054 tons. Now, that's probably a made-up number. Okay? Nobody knows what the Chinese gold reserves are, certainly not anyone over on this side. Okay, but that's what's published by the IMF because that is what has been chosen to be presented to the IMF. Okay, now so gold, they have about 3.8 trillion in foreign exchange reserves. That's at 3,843 that you see there. So gold as a percent of the two, if I convert gold to at $1,200 an ounce, gold is about 1%. Now, you might recall that the ECB chose the number 15%. For China to move to 15%, China would need 13,000 tons of gold. So it would spend some of the 3.8 trillion on gold, and so the gold component would rise to around 15%. That's not an unreasonable number. You know what it is for the United States. It's way over 70, right? And Europe collectively has a very high gold holding. Okay? Now, the locals, I mean, some of the researchers in China have argued that China should at least have 5,000 tons of gold. Okay, so you see, part of what's going on here with respect to the rise of the RMB is a very quiet but long-run demand that you're going to get for gold as a reserve in China. China also wants to include the renminbi in the SDR basket. Now, there's a whole history to the SDR basket, and you can go online to the IMF and you'll get a nice 1- or 2-pager that explains the history of the SDR. It was originally introduced as paper gold, and it was made equal to $1, and it was to replace the lack of growth in the world reserve system that came from the gold price having been set free, and Africa wasn't selling anymore to the central bank community. So gold froze in the central bank system, and they had to come up with some other reserve. And nobody wanted US dollar reserves. Well, flash forward, we're up to here in US dollar reserves, and the SDR basket is now partly dollar, partly euro, partly pound, and partly yen. To have the renminbi join the SDR would be a phenomenal win, if you will, for China. It's not clear, given what I said about the Chinese financial system, that this would actually work well, and I expect, most likely, the US will block it. All right? But that's more for reasons that these markets aren't open than for anything else. But, you know, that's politics, and I don't necessarily always read that correctly. But it would generate an increase in the demand for SDR, and it would potentially prove to be a bit of a turning point in the dollar price, which is something that we heard people talking about. Meanwhile, behind the scenes, this is what's going on with gold demand in China. Now, these are the Shanghai gold deliveries. Now, I don't want to say that Shanghai gold deliveries are equal to on-the-ground gold demand. There's a lot of evidence to say this is overstated significantly. But I'm interested in trends. And you can see that this is increased, and if I do it differently, if I do it on a cumulative yearly basis, you see what happened. This year to date, 647 tons were delivered. Last year, 585 tons. The year before, 475 tons. What does that tell you? The gold activity in China continues to rise. Okay? And that's good. Okay? I think that the Chinese would like domestics to own more gold, because I have this sneaking suspicion that sometime in the future, that could be 10 years from now, the Chinese government will suggest that maybe some of the gold that is being held by Chinese households ought to be turned into the government. And that would make sense if you wanted to make a gold promise to an RMB. This is, of course, exactly what Roosevelt did in 1933. Okay, so there's potential there. Meanwhile, and that's the red bars, that's the grams of gold per capita consumed by China, will continue to rise. I think that's a very important medium long-term development. The rise of China, the demand for gold as a reserve item that could potentially support the RMB, and the opening of markets in the Far East that encourage more people to consume and invest in gold. The Eurozone, point 3. It's difficult for a Canadian to come here and talk about the Eurozone, but I'll be a little bit brief. I've got a couple of interesting charts, and this is one of my important charts with respect to the Eurozone. And what this is the currency exchange rates relative to the Deutschmark between 1957, when you got currency convertibility in Europe, and 1999, when the euro was introduced. Now, this is relative to the Deutschmark. All I'm trying to say here is, how did the world here behave before the euro? Okay? Because we kind of know how it's behaved after the euro. Okay? Well, you know what the bottom line is? right at the end, you may not be able to see that, but that's 4.3. So in other words, a currency went from 100 index to 4.3. That was the Greek drachma. Okay? The best currency of the lot went from 100 to 24.8. You know which currency that was? The French franc. You've probably forgotten, Mitterrand decided back in 1980 that he should nationalize all the banks. Germany doesn't nationalize banks. Mitterrand nationalizes banks. What's a currency person going to do? He's going to short the French franc. And of course, the French franc fell out of the snake and all these other things. Remember the ERM and all that stuff that was going on before. So basically what I'm trying to say here is that prior to the euro, you know, devaluation came with mother's milk. You know? People vote for the government. Yes, give me what I want. Great, you get it. A year later, your currency's devalued. Well, that's Hans Werner Sinn. What has happened since? You can't devalue. So I'm going to ask you whether you see any behavioral changes in Europe from before the euro to now. Because if these currencies were all still independent, they would all now be devalued 30, 35, 40%. That would get Spain and everybody else back online. So, but I don't want to say that that's a Canadian view. So I'm going to take the view of somebody who is well known in Europe, quite famous internationally, Hans Werner Sinn. He's the head of the IFO Institute from Germany. Okay, now he is also, I might say, maybe he wouldn't agree with this, a bit to the right of Attila the Hun on some issues. Okay, so I feel very comfortable quoting him because many of these views are mine. First, the South is uncompetitive relative to the North. Point one. Point two, financial rescue packages have only allowed Southern Europe to remain overpriced and avoid paying for their poor decisions. Okay? Three, countries like Portugal, Greece, Spain need to devalue by about 30 to 40%. Okay? Four, Ireland. Hey, Ireland adjusted, but you know when they adjusted? Before there were all these handout packages. And so this is a little stinger at the end there, right? Greece received the most rescue funds and now has the highest unemployment rate. Spoken like a true conservative. So that's his view. Okay, what to do about it? Well, Europe can become a transfer union. Okay? The North is going to pay transfers to the South. He says, I don't know, that creates a permanent dependency. Well, I'll tell you how it goes in Canada in a second. The Southern zone can deflate. Well, yes, it can. Ask Greece how it's going, right? The North can inflate. Okay, now if you ask me as an economist, you know what would be really nice? Is put all the Germans on half-time, pay them full-time, and send them all to Greece on holiday. Okay? Because that's the imbalance. Okay? That's the massive imbalance that we have in the European economy. Okay? And we can't adjust. You know, imbalances happen in the world economy, and we need exchange rate to help adjust. So he says uncompetitive countries can exit and devalue. Well, obviously, that's one of the things that's being done. So then he gets to, well, what about the QE from the ECB? Well, it's a wonderful thing, he says. It will lead to more inflation and devaluation, only it will mean devaluation for the euro. And that is actually awkward, because what we need in Europe is a relative adjustment. We need the South to deflate relative to the North, not the whole shoot and caboodle to deflate relative to the US. I don't know if you know, but a Mercedes now today costs less in Canada and the United States than the big Chevy. That's how cheap it's gotten, the euro. For me, it is unthinkably cheap, the euro, in terms of the goods that we trade internationally. All right? But, hey, he hopes that the South will stay the course on austerity, and I suppose everybody hopes that. Okay, what about Canada? And I wrote this very early on when I saw how these things were going in the euro, and I said, okay, Canada isn't the end-all and be-all, but we got 10 provinces. Each province issues debt, And there are 10 different interest rates. They don't really converge, okay? My apologies to the Quebecers. They pay more than the Albertans pay. Now, that may change as Alberta is losing oil, but that's the way it is to now, okay? So there you can say, okay, well, that's similar. You got, interest rates in Europe. They're not all the same, although they did converge. But we have one central bank, okay, that's the ECB, right? But it can buy a bond from the central government. That you don't have here, okay? And now we have this wonderful thing in Canada called a system of equalization payments. Now, I grew up in Alberta. I was born in Amsterdam. We immigrated to Alberta. And I tell you, I hate equalization payments, okay? Alberta has been paying equalization payments to the rest of Canada for every year that I have been in Canada. That's many years, right? So you ask yourself, would Alberta vote today to join Canada if it was made clear to Alberta that when they join Canada, they will have to make transfer payments forever and ever, amen? Because that's sort of the question that is being put to some of the other countries in Europe. Well, thankfully, we don't have to fight that battle. This all came after, right? We collectively voted on it, and Alberta, hey, Alberta was outvoted. Okay, that's how it goes. And we have one bank supervisor, and the bank supervisor can merge banks, not allow banks to merge, whatever. Okay, now in Eurozone, you don't have a Euro bond. The ECB isn't actually technically allowed to buy government debt. Okay, so we have a trick. We do it on the secondary market, right? But not in the primary market. You're not allowed to do that, right? There is no transfer payment. Well, because, hey, you know who doesn't want transfer payments, right? The North. And, okay, we have something called an SSM, a single supervisory mechanism, but it doesn't work like the OFI. So I just point this out in terms of where you would have to go to make this thing work properly. Believe me, you're going to be, or not you per se, but the North is going to be making transfer. They've already been making transfer payments, only we call it the Target 2. All right? Okay, what is one? Okay, this is an economist's ideal breakup. It is totally politically unworkable. Okay? That's why we're economists and, dinner entertainment. All right? We don't make these decisions. But my view, and this is basically from day one, the North should leave and the South should be the Eurozone and have the Euro. Why? Because the South owes the North. That is, it owes the North money. And if the North stays in the Eurozone and the South leaves, how are you going to redenominate everything? Right? So now the South, and of course the ECB will move to Paris, right? And they can print and do whatever they like. And they will pay off euros to the North because that's what they owe, euros. Right? And the North will complain because they're not getting full value, because whatever currency they adopt, it will be the DM, say, it will go up against the euro. And they'll complain, and you'll have all kind of learned essays about how they're losing wealth on this. Well, I've got news for the North. They've lost already. This ain't going to get paid back. Okay? It's done. Okay? It's just a question of how are we going to fight over the IOUs at this point. Okay. What's likely, more likely, is that Greece leaves. If there is a breakup, this would be the way it goes. Okay, then the question is, what happens to the 247 billion euros that Greece owes to the public sectors? Well, I have no answer for you. Presumably, Greece is just going to default or try as best as it can to write all that stuff over to drachmas and pay it off in drachmas. And of course, the rest of the, there's going to be all kinds of legal, if you're a lawyer, this is going to be manna from heaven for you. Okay, because there'll be all kinds of legal situations to how you do that. 70 is debts to the private sector entities, and these, of course, are Greek banks, and that you can write over into drachmas, and that will clean itself off. because the government can now print drachmas, the Bank of Greece. So you got one or two. The economist solution, which is politically unacceptable. And the reason it's politically unacceptable, I believe, is because as it stands, they don't want to split France away from Germany in the euro system. But technically, France, from my perspective, is a bit of a southern country, right, and doesn't really fit well with the northern country. But that's an economic opinion, and you can think about that. House prices. Are you still with me? Okay. Okay. Thanks, Sean. These are Swiss house prices. Now, that's indexed to 1976, quarter one is equal to 100. And it's inflation adjusted. So this would be the local house price adjusted for Swiss inflation. So, holy, that's pretty expensive stuff, right? House prices. And I think, certainly we that come from elsewhere would say, boy, things are expensive here. Well, let's put a different perspective on this. I've got Switzerland circled there. Okay, what this is data from the OECD, not made up. This is actual data. Okay, and what these bars are, you have to understand, it's a little complicated, but take the blue bar. That is the ratio of house price to rent. Okay, so whatever the rent is, right? So there's an index for rent, and then you have an index for house prices, and you take that ratio. Okay, what the 100 line is, that's the red line, that's the long run average for that country. Okay? So now what you see is that Swiss house price to rent ratio and house price to income ratio is pretty well dead on its long run average. And so you start to identify which countries might actually have expensive houses. Well, I come from Canada. I can tell you it's expensive there. All right? Well, let's look at this a little bit differently. Now we take the same series that I had for Switzerland, the inflation adjusted, oh no, here's not inflation adjusted. Residential property prices. This comes straight out of the database from the Federal Reserve, because they keep a very large international economic database. Index back to 1976. He said, woof, look at the UK. Now, has anybody thought the UK was expensive? Well, if you heard James Turk there the other day, he said, £2 million gets you, well, basically nothing in London. Right? So that's sort of, okay, but that's what these index. Look at Switzerland now, okay, nominally. Okay, well, that's a problem nominally because you got different inflation rates and so forth. So now I inflation adjust the data, and you see that UK still stands out. And then I thought to myself, you know what? I'm from the dollar world. Let's look at this as to what it would cost in dollars. So now I take the nominal house prices and convert it all to dollar terms. So in other words, I adjust for the exchange rate. You see, Switzerland, Canada, and the US are about the same, plus or minus. Maybe Switzerland is a little bit pricey, but certainly not out of scale. So the message here is, don't worry too much about the house prices here. But if you can at all manage it, maybe you want to sell your properties in the UK. Okay? Right? Because how this will adjust is the pound is going down. Okay? When the pound goes down enough, that UK price will come right back down to the other prices. Okay, last. Gold price ratios. I'll conclude with gold. Okay, what I got here is something that gold people will recognize immediately. This is the ratio of gold to oil. And we've looked at it for years, and there happens to be relationships between gold and oil, and they come in these relationships come in different ways. Oil, as you know, feeds right into the inflation data, and so on the one hand you get oil prices rising and inflation rates go up, and some people might be encouraged to buy some gold because inflation went up, right? Okay, so that's one. The bigger one, at least back in the 70s and early 80s, was that when the price of oil rose, it enriched a very few people to a fabulous amount. And these people do not necessarily want to keep their wealth in US dollars. And so you got gold buying. So that's the wealth effect that comes with higher oil prices. Okay, I kind of think, you know, I don't have all these facts at my fingertips, but I'm thinking, you know, what would a Russian oligarch do now that he can't really put his money into a Cyprus bank? Okay, maybe he might decide that, okay, I'll go differently. I don't want to be bailed in again. You're right. I'll do gold or something like that. Okay, very recently we saw the oil price drop sharply, and that's what accounts for that very sharp spike. You can see there back to 1970, it's a fairly stable relationship. Now, at the panel discussion yesterday, I said, look, these relationships break down over the long run. But, you know, and maybe, you know, 40 or so years is the long run. But I want to point out that rise there of gold against oil, because a gold bear would say, hey, gold ought to go down. You know, you might want to say oil should go up, but what's the likelihood of that? Well, here's the price of oil, and I have logged it so that it's log form so you see the trend. Okay, the point I want to make here is, note this period where I've got these two red lines. That's a period that runs from roughly 1986 to about 1999. The oil price stayed relatively low. Now, what happened in '86? Because you see there a sharp break. Well, you go back into your Wikipedia analysis and so forth, and you'll see exactly what happened. The Saudis had it up to here with all the people that weren't adhering to production quotas and so forth, and said, the heck with it, we're not going to be the swing producer, we're going to open our taps and we're going to keep them open. And oil prices were low for the next 10 years. Okay? And I think, which is actually some good news for gold miners, we could be looking at a quite long, that's not necessarily 50 or 60 or 40, you know, that's a bit difficult to judge, but we could be looking at low oil prices for many years to come. Which then means, if I go back to this ratio, you see that back in that period when oil prices were so low, gold was actually quite high relative to oil. And I think we're going to see that too. All right? It doesn't mean to me that gold would have to come down because oil prices went down. And the last chart I want to show you is the gold-silver ratio. Now, this is a little bit more technical, if you will. What we have noticed about the ratio of gold to silver is that when that ratio declines, i.e., gold prices are falling relative to silver prices, actually both metals are going up. It's just silver is going up faster. Okay? So we use this as a little bit of a technical indicator. And you can see there, I've got it in green, gold rises, and you see that massive decline in gold-silver ratio because silver rises faster. And it looks to me like we're sort of at a possibly an inflection point. Okay? I'm not a technical analyst. I draw lines like other people draw lines, and most of the time I say, what the hell did I just do there? I don't know what that means, right? But I throw it out at you because that's one of the things we're looking at the moment, is what is the market telling us with respect to gold and silver. And if this does turn, then indeed we will have a rising gold market. And so not to dodge the issue, our forecast for this year, model-wise, you know, because I do a lot of computer kind of stuff, it was 12.25 as an average for the year, but I added $25 for geopolitical noise because last year, for the LBMA, the London Bullion Market Association, I forecast 12.50. That was my average price for last year. The gold price ended up averaging 12.66 last year. And I thought, okay, well, that's not that bad. But what happened? And it turns out that the whole Crimean crisis thing, which bumped gold prices up, as an average for the year, believe it or not, added exactly $16. So I thought, okay, I'm not going to make that mistake again. So I got 12.25, and I'm throwing in 25 because I think this is a very difficult year geopolitically and geofinancially because a whole bunch of things have to be, excuse me, resolved. And I think you know those issues. So let me leave that with you, and thank you for your very patient attention, and let you go home.